Okay, this is the video solution to Vasquez Supply Company from chapter 12. This is a person who is a new accountant, and she comes with experience using standard costing. Okay, and don't forget that the reason why we even have volume variance and all of that is because of the use of standard costing. So we've got standard costing actually on the books, but we have to, we've got to bring the actual amounts to bring it down to actual amounts for the financial statements at the end of the year. So that's when you calculate your variances and then close them, okay? And the volume variance is always a tricky one to see, so we're dealing with that specially. So this is what we've got. We've got information for the last 2 years. So for 2 years, it looks like they budgeted $120,000 per year. And the budgeted fixed manufacturing cost was $720. Budgeted fixed operating expenses. Okay, so this is fixed manufacturing. This is fixed operating. So if I were you when I was on an exam, I would underline those words just to make sure they registered in my head. Okay, so that's $535,000. Budgeted variable operating expenses $12 per unit. Budgeted variable manufacturing cost is $32. So this, again, remember, includes direct material, direct labor, and variable overhead. Okay, the budgeted selling price is $60 per unit. So and that's what would have been booked. So then we've got some inventory information. Okay, so we had in 2025 we started out with none. We produced 115,000. We sold 112,000. So that we ended up with 2,600 that would have been the beginning inventory in 2026. Then we produced 122,000. So we had 124,600,000 and 124,000 were sold. So they also tell us that there are no price or efficiency variances for either year, which is really good. Okay, so all we got to do is worry about the fixed manufacturing overhead volume variance. And what they do is they write it out to cost of goods sold. So the first thing you're going to do is determine the per unit cost that would be capitalized under each system. And don't forget, when we say capitalized, we mean put into inventory. Okay? So our per unit under variable costing, our variable cost per unit is $32 per unit. So that's what it would be. Okay, just the variable cost under variable costing. Because don't forget that fixed overhead is written off in total. Under absorption costing, we've got fixed manufacturing cost of $720,000. Our budgeted production was $120,000, so that's $6 per unit of fixed cost. So our variable manufacturing is $32. The fixed manufacturing is $6. So our per unit cost under absorption costing is $38. Okay? So then the next question asks for, and just notice the only difference between these two is that fixed overhead, okay? Because this is a fully absorbed cost. It absorbed the fixed overhead. So where are we now? So the next one, calculate the ending finished goods inventory balance under each costing system for 2026. Okay, so under 2026, so we've actually got to do it for both under each costing system. We got to do it for both years, though. So here's our inventory in 2025. We started out with 0, produced 115, sold 112, ending at 2,600. 2026, there's our 2,600, produced 122, so we've got 124.6 available, minus sales of 124, excuse me, gives us 600 in ending inventory. So now these are a little weird. This is my organization is strange. So here's variable costing here. We start out the year, in 2025 we had 2,600 units at $32 per unit, and variable costs, that's $83,200. And in 2026 we've got 600 units at $32 per unit, or $19,200. Okay, so that's the ending inventory balance under variable costing. On an absorption basis, for 2025, we had 2,600 units at $38 per unit, so that's $98,800. And then in 2026, we've got 600 units left at $38 per unit, or $22,800. Okay, so now, whoops, I should have left it there. Here's our volume variance. The volume variance exists because we've got a difference between budgeted and actual production. Okay, and the issue is that we base our fixed overhead rate based on budgeted production. So if you actually produce more or less than that, you're going to have a volume variance. So in 2025, our budgeted production was 120,000. We actually produced units produced were 115,000. So we're 5,000 units under. It's $6 of fixed manufacturing overhead apiece is a $30,000 unfavorable volume variance. Okay. In 2026, again, we planned on producing 120,000. We produced 122,000. So as soon as you see this, okay, you can see that we pushed more through production with a fixed amount of production, so that's a good thing, okay, and that would be a favorable variance. So that's 2,000 units more than we planned at $6 a piece is $12,000 favorable. Okay. Now, here is an absorption income statement, okay? And this is a slightly different format. I think it's better to do it the other way. I should maybe I'll upload another copy, but here are sales for 2025 and 2026. And cost of goods sold, its standard is $38 per unit. This is under absorption. $38 per unit, so $42.71 and $47.12, and then you can put the volume variance down here just as a line item. Okay, you can do that. So this would be unadjusted cost of goods sold, and then you'd have volume variance, and then you could have adjusted cost of goods sold. Okay, but here the volume variance is just here. It does adjust the cost of goods sold account. It's unfavorable here, so it increases the expense. And this is our gross margin. Okay, here it's favorable, so it decreases the expense, and this is gross margin. Okay, don't forget we're doing absorption costing. Then we've got fixed operating expenses and variable operating expenses. So again, under an absorption basis, everything above gross margin is a product cost, and then beneath it is a period cost. So we've got operating expenses in on a fixed and variable basis. So here's our operating income on an absorption basis. Whoops. Oh dear. Okay? Okay. Okay, we just finished the statement on an absorption basis, and now we'll do it on a variable cost basis. So that is variable costing. This is part E. Here we've got our variable cost. Here are our sales. The variable cost is not $38 per unit, it's just the variable cost, so that's $32 for 2025 and 2026. That gives us, now I added this, this is a product contribution margin here. Okay, and you'll see that if you ever see these statements, they'll separate it to sort of keep the product flavor there before adding your variable operating costs and getting an actual contribution margin. Okay, I mean, this is sort of a meaningful number. This is something you could use, you know what I mean? So here's variable operating costs then, and our contribution margin, then less fixed operating expenses in total. Okay, see, our budgeted fixed operating expenses were $535, so they are deducted in total each year, and the fixed manufacturing costs were $720,000. That's what I meant. These are really deducted in total. So here's our operating income under variable cost basis. Now the last thing that you need to be able to do is to reconcile the absorption numbers with the variable cost numbers. Okay, and the difference is going to be based on production and units produced and the actual sales. Okay, so we've got in 2025 our absorption income was $559,000. We produced $115,000 and sold $112,000, so that's $15,600. I might add something different here, so I'm going to stop right here and then come back to this in another video, I think. Okay, we can use this The difference between the two is just going to be the change in inventory times the fixed manufacturing overhead per unit, okay? Because the absorption income is usually less than what depends on which direction inventory is going in, but it's going to be different based on how much fixed overhead they have attached to units in inventory. So in this case, we produced 115,000, we sold 112, so inventory increased. Okay, so $6 per unit went on the balance sheet. Okay, so variable costing income would be less by 15.6 or 543.4. Okay, so that's your difference. Okay? All right, it's all going to be based on that. So the last one then, in 2026, we've got absorption costing of 717,000. And in this case, we had 122,000 units produced, but we sold 124. So in this case, some of those units are coming out of inventory and washing through cost of goods sold on the income statement. So when inventory is decreasing, I think that's what happens. It's going to variable cost income is going to be higher than absorption income. So make sure that you understand this, okay? So 717 was absorption income. I've got 2,000 units at $6 a piece that it's coming out for that is in here for variable costing. So variable cost income would have been 729,000. I'm glad I got that out. Okay. The last couple of questions here. Which method would you recommend for internal performance evaluation purposes? And that would definitely be variable cost, because you can see what that volume variance doesn't exist. You're taking out your fixed overhead all the time because it's not really in the control of a manager. And then for preparing financial statements to receive a loan, I would definitely do absorption costing only because it's required. Okay, it's required by GAAP, so you don't have any choice. Okay, now I'm done.